So the Bank of Japan has finally surrendered to inflation and pivoted. Now, for the first time in 15 years, Japan, they raised their benchmark rate to 0.5%, and somehow the whole world is shocked. Now, if you have been following this channel, you know Japan had no choice but to raise rates and turn hawkish sooner or later, right? This is why I'm calling it the dumbest pivot in history, because it is a self-inflicted wound. And because the whole world somehow couldn't see this coming, higher rates from Japan might actually trigger a sovereign debt crisis and take down global bonds. So if we recall, Japan has been aggressively easing, right? Keeping their interest rates low at near 0%. And because of this, inflation in Japan hitting a 40-year high of 3.6% in October, everyone's freaking out. Japan has freaked out. But here's the insane part. To fight this inflation, Japan is going to spend more money to solve the problem. You really can't make this stuff up. Just a month ago, they approved $200 billion in stimulus spending to ease the pain of inflation, right? And the majority of it is going to be fueled by more debt. And this is why investors were fleeing Japanese bonds and moving into treasuries. And this is why the yen was crashing all year long until they decided to do the pivot. And it's because of this money printing misadventure that Japan has doomed their economy and could very well take down global bonds if their interest rates go high enough. And let's be serious about this, guys. A pivot should never have happened, right? It was never needed in the first place. Modern monetary theory, Abenomics, Kuroda's policy, whatever you want to call it, it has failed. The market forces has pinned the Bank of Japan into a corner and forced them to pivot. But Japan's economy is much weaker right now. They have printed up trillions of yen. Their debt burden has grown to almost 1 quadrillion yen. That's $7 trillion worth. And a lot of this debt is held by the Bank of Japan. And if we take a look at Japan's treasury holdings, they have been selling off their treasuries, dropping by more than $200 billion since February. They are selling off their dollar reserves in order to prop up the yen, but it has not been working. It's only when Powell hinted at the smaller rate hikes in December and Japan's actual pivot back to tightening that the Japanese yen started to recover, right? But it is still down over 13% because too much confidence has been lost. Too much money has been printed, and this is going to boomerang back to hurt the Japanese economy. Now, we have talked about this many times about how money printing always backfires and how the Bank of Japan will have to eventually reverse course and jack rates back up, right? Essentially, Japan has lost the battle of the yen. They have lost the battle to inflation. They have realized that they don't have enough dollar reserves and they can't outlast the Federal Reserve when it comes to higher interest rates. Now, I don't believe Japan would dare to reverse course and start printing money all over again, but it's definitely possible, right? Anything is possible. But that will crush the yen and destroy any credibility left the Bank of Japan has. Now, investors, they are beginning to realize that Japan is running out of options. Holders of the JGBs are starting to sell off their bonds because prices are going to collapse as Japan starts to raise interest rates. And that's why we see this insane spike in the 10-year Japanese bond to almost 50 basis points. And this is going to cripple Japan's economy. At this point, Japan's stock market has reached legendary status, right, for being flat for decades. Their stock market, the Nikkei, has not moved. And if you compare it to the S&P 500, we can see a big disparity in performance. Over the last 30 years, the S&P is up by over 2,400%, while the Nikkei has barely scratched 10% gains. They have suffered 3 lost decades, guys. And this brings us back to the reality that Japan has a demographic issue and a fertility crisis. The birth rate in Japan will hit a new record low this year, and no amount of money printing is going to solve it. In fact, it will just cause the yen to crash even further, cause inflation to spike, and make it harder to form families, right? Now, Japan, they're thinking of giving an additional 80,000 yen a child to boost the birth rate, but that's only around $600, as good as nothing. Now, not every issue can be solved through monetary policy, we know this by now. That's not how the real world works. The BOJ is practicing fantasy economics. But Japan's pivot could very well trigger a bond crisis like what happened in the UK a few months back. Remember what happened when the yields on the UK gilt started to soar? We saw pension funds collapse because they were leveraged on bonds, so they faced huge margin calls. And this resulted in the Bank of England coming in and bailing out their economy by buying all these UK bonds back to drop down the yields, right? Now, there are reports that Japan's life insurers are well capitalized and probably won't face the same pension crisis as the British, but it's still a tail risk we need to watch out for because if the yields on the JGBs they rise to 2% or even 3%, this could very well collapse both the bond market and the stock market. And that's why I believe Japan has dug itself into a deeper hole today. They have fewer dollar reserves now, and their debt is humongous. And with rising rates, their economy is going to slow to a crawl. Their industries are probably going to get hollowed out like Europe and lose ground against China and America. So I won't be surprised if they have another lost decade or two. But this situation is about to get worse. Japan's pivot and rate hikes could trigger the next global bond crisis. Now let's rewind back time to a few months ago where the BOJ was still easing and the yen was still crashing, right? Investors were running away from Japanese bonds. There were massive sellers dumping over $6 trillion worth in September alone. That's just 1 month. And global funds and Japanese investors, they were taking money out of the JGBs and they were net buyers of US treasuries because the yields were better and the dollar was strengthening. But now the reverse is going to happen. If Japan keeps hiking rates, we're going to see global bond yields spike. We're already seeing it in the US 10-year where yields have almost jumped from under 3.5% to almost 3.7%. And that's a huge move in just a few days. So let's understand what really happens when Japanese bond yields rise. Yes, it will be bearish for Japan's economy, but it could trigger a big liquidity rush out of Western bonds back into Japanese debt. Now, we're talking about money leaving US treasuries and Euro bonds and flooding back into the JGBs. And to buy Japanese bonds, you need yen. So the higher the BOJ raises rates, the stronger the Japanese yen will become. And this is the big threat that the markets are not pricing in just yet. Japanese savers and investors are bringing home their money away from the West and adding pressure to US treasuries. So even if Powell stops hiking or slows it down, what Japan is doing could very well spike yields higher and trigger lower bond prices in the US. The yen carry trade is closing, and if it ends, we could see another debt crisis. Now, will this alone collapse the US bond market? I seriously don't know. But this is another de-dollarization event from Japan amongst many others in the world, right? We already have the market predicting a 70% chance of a recession in 2023, and according to economists, the US economy is facing big headwinds from surging interest rates, high inflation, the end of fiscal stimulus, and weak export markets abroad. And if Japan continues to hike rates, we're going to see the US economy take a beating and the stock market also suffer, right? Because now it's truly global demand destruction. Every single country today, except for maybe China, is hiking rates to crush inflation. The cavalry is not coming, and the markets, the S&P, still has more room to fall. And this dead cat bounce isn't over yet, courtesy of Japan. So there are a lot of signals blaring that a recession is coming, and Japan's pivot could be that final straw that breaks the camel's back. But more importantly, this is a lesson, guys, that printing money and manipulating interest rates just makes things worse. It destroys the value of currencies and doesn't solve any of the structural problems. I believe Japan is going to keep hiking up because inflation is becoming a real problem and the yen is still in crisis mode, right? If they decide to do another pivot and start quantitative easing all over again, this will just crush the Japanese yen. Now, Japan's public debt to GDP is already at a crazy 262%, and this can't go on forever. Yes, a lot of it is owed to the Bank of Japan, but this just shows us that the Japanese economy is being propped up by funny money. It's not true genuine growth. And this is why, as we continue towards 2023, my focus is still on cash and gold, but the last thing in the world I would ever touch are Japanese stocks. They might have doomed their own economy for the next 10 years with their flip-flopping around. So let me know what you think in the comments below. Will Japan continue hiking rates to save the yen, or will they flip like a pancake again and start printing money all over again? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.